a big round of applause for Logan Mohtashami.
Do you want to catch it?
Yeah. How's everyone doing today? Good. Okay, so lead analyst, Logan Mohtashami. Our family's been in banking since the late 1950s. I was an LO for 17 years before I retired early 2020, so I understand what some of you are going through. My job today is to just basically explain to you what is going on with the housing market, and at the end of this presentation, I'll be able to slide into your DMs with all the charts here. You could do it with a QR code, and you could present this to your clients, and I'm convinced everyone in here has an Uncle Dave. Somebody that comes for Thanksgiving and Christmas and tells all the kids, don't buy a house, it's housing 2008, you're an idiot. Okay, our job is to explain the data to the way that all of you can present it. And then what we've found out over the last 2 years is that realtors and mortgage people, when they show the charts, all of a sudden clients go, wow, I didn't know that. So if I do my job right, you will know more about the housing market than 99.9% of the people on planet Earth, but you'll be able to explain it in a very confident way. So when I say get excited about the future, my theme is that the worst in the housing market is already over. Right? Home prices were escalating out of control. The Federal Reserve was raising rates. Mortgage spreads were bad. You know, home sales have bottomed out. Right? The Federal Reserve is in a rate cut cycle. You'll see, we'll talk about mortgage spreads. They're getting better. And we've had one period in time in history where the housing market today resembles what we've had in the past. So I first ask, how many people here have been married for 20 years?
Or more.
20 or more. How many people like to slow dance here? Okay, good. There is a couple that have been slow dancing since 1971. It is the 10-year yield and 30-year mortgage rate. And what we like is very intimate slow dancing, right? We like the spreads to be very close. We like the mortgage rates, the 10-year yield and 30-year to be very close. But what drives the 10-year yield is what drives mortgage rates. And I think in the last few years, a lot of people kept on saying mortgage rates will go down, inflation will go down. It's not necessarily how it works. 65 to 75% of where the 10-year yield and mortgage rate can go is really Fed policy. And Fed policy was not going to be breaking anytime soon until the labor market breaks, and we're going to kind of show that here. But as you can see, this relationship has been very simple. I mean, the growth rate of inflation kind of moves with this as well. All we need in the U.S. is mortgage rates just to head down to 6%. I know a lot of people thought rates have to get down to 3, 4, 5, but the last 2 years we've had near 5 million total home sales. Right? The peak in the last decade was near 6 million. So we're missing 1 million mortgage buyers, even with home prices escalating out of control, even with mortgage rates elevated. We'll explain why going out in the future. Now, as you can see here, the 10-year yield, right? The 10-year yield, when it gets to this peak, right about there, the history of economic cycles is when the Federal Reserve tells the marketplace they are done hiking rates. Usually that's the peak. So when I say that the worst is over, unless something crazy happens, right, we've already seen the peak of 8% mortgage rates. How many people here are familiar with the term mortgage spreads? Actually, no, Utah's actually the highest in the country. Usually I get 1 or 2. It is really important for everyone in this room. Mortgage spreads are the difference between the 10-year yield and 30-year mortgage rates, right? And when we talk about the slow dance, we want intimate slow dancing. Like in Soul Train in the 1970s, we get that intimate slow dance. Mortgage rates compress, they get better. The spreads were terrible. In 2023, the Silicon Valley banking crisis happened. Mortgage spreads blew up to about 3%. That was the worst spread we've seen in over 15 years. However, the history of economic cycles is that when the Fed starts cutting rates, volatility compresses, the spreads get better. So let me give you guys some numbers. If I took the spreads from 2023 and I put them in today, mortgage rates are 75 basis points higher than what they are right now. If the spreads get back to normal, which is about 160 to 180, mortgage rates are 75 basis points lower. We're sub 6% mortgage rates. How many people here will do more business if mortgage rates are under 6%? Everyone. That's what the data has shown. It's just every time when mortgage rates get down to 6%, the Federal Reserve comes out and goes, no, we don't like this. Market's getting ahead of themselves. But what's happening right now with the spreads? Improvement. We see it in the data. This year, shockingly enough, not a lot of people are talking about it on the media, but purchase application for the first time in many years is positive year over year. We'll show that a little bit now. But when I talk about the Federal Reserve and when will mortgage rates really get down to 6% or below, the Federal Reserve wants the labor market to get softer, because when they get softer, they feel more comfortable about cutting rates. They did not cut rates until they saw the labor data getting softer. Then they did a 0.5% cut, another 25 and 25. So if the labor market does get softer, my term that I brought up in 2022 was that focus on the labor market over inflation. For the past few years, a lot of people say just focus on inflation. That hasn't worked out because the Federal Reserve policy is really based on the labor market. Finally, after 2 or 3 years, they're starting to admit it publicly. So when we think about housing, the softer the labor market goes, the lower the mortgage rates go, and they can stay there. But if the labor market stays still a little bit too firm for them, rates can stay elevated. So here's the growth rate of inflation on a year-over-year basis. Inflation rarely goes negative post-World War II. We had pretty stable inflation for the 21st century. We had zero interest rate policy, QE1, QE2, QE3, deficit spending. We couldn't get inflation to break out ever. What was one event that created inflation to break out? Global pandemic. What is the history of global pandemics? Very inflationary, and then the disinflation happens. Very normal. The Federal Reserve did not need to raise rates up to 5.5%. This was going to happen regardless. Why do we know this? Because it happens in every single global pandemic in the last 500 years. Supply chains start to work, right? Even though demand is good, the economy is good, the Federal Reserve's own model, the growth rate of inflation fell faster than what they forecasted. And still rates are elevated. Why? Because it's the labor market they're focusing on. But it is very, very hard for inflation to break out again unless we have a supply shock somewhere. Now, the unemployment rate, the Federal Reserve, before the year started, I talked about the Federal Reserve kept their unemployment rate target low for a reason, 4.3%. If the unemployment rate went to 4.3%, the Federal Reserve would be concerned. Well, in about a span of 6 weeks, they've raised their unemployment rate target, right? Basically telling the bond market, it's okay if the 10-year yield and mortgage rates start to go down a little bit more because we're a little bit more concerned about the economy. For everyone in this room, a softer economy means lower rates, right? We had an economy that was growing. We had the labor market that was beating estimates. We had the fastest crash in home sales ever, and it's basically staying at record low levels now going into the 4th year. So softer economy, lower rates for longer, everyone does more business. Now, the one data line that the Federal Reserve loves to track is every Thursday is a thing called jobless claims. Jobless claims are people that apply for unemployment benefits. Back in 2022, when I brought up with the labor over inflation Fed policy, by the way, I still think somebody egged Fed's spiced the Fed's eggnog in December because we had a really good thing going. The Federal Reserve before Christmas said we would like inflation and the Fed funds rate to kind of stay somewhat in line. And I was like, oh my God, that's great. Guess what? We would have 5% mortgage rates today if that was the case. And then something happened in December of 2022 that made me think, oh, they're targeting the labor market. Jobless claims right now, still very historically low. If this data line heads toward 300,000, mortgage rates will go lower and stay lower. So everybody at that point could gear up for more business for longer because that means rates could stay lower with a longer period of duration. Now here's the cheat code. Every economic cycle post-World War II, we've had always people every single year where the U.S. economy is going to recession, it's terrible and everything, except they forget one thing. Traditionally speaking, residential construction workers lose their jobs before every recession. Very simple model here. The Fed raises rates. They keep policy too restrictions too long. The builders start reducing permits. Housing starts fall. And residential construction before every gray bar starts to fall down. Well, That hasn't happened yet. So all the recession callers were missing the cheat code data line. However, permits are at recession levels. Housing starts are at recession levels. The builders' completed units for sale are at the same levels that we saw going into 2008. So the builders are a little bit stressed here. If this data line starts to fall, and in time it will, everyone here, oddly enough, does more business because rates could go lower. Now, why do we know the builders are feeling stress? Boy, this is their confidence data. This is something the Fed actually does take into consideration. If the unemployment rate starts to pick up and the builders are feeling this low about the new home sales market, and let's remember, the new home sales market is at 2019 levels. They are not at record low levels. Why? The builders are offering lower rates to everyone. If we had the same rates the builders had, sub 6%, that's 1 million extra existing home sales. We'd be pretty much back to normal, right? They can do it even with a more expensive product. Everyone here does more business if we get sub 6% mortgage rates. But this is something that I track religiously. And lately, as mortgage rates stayed elevated, tariff talks really impacts the builders. Things are getting softer there. This is something that I keep a track of every single week. If this data line starts to break more, the Federal Reserve, that is something that they care about. The existing home sales market, not so much, but this is something that the Fed can mindfully say more dovish statements going out in the future. So always think, labor over inflation, residential construction workers, if those fade, gear up for more business. Now here's the Fed's favorite data line that a lot of people hate. This is the job openings data. As you can see, things got pretty wild during COVID. Job openings got up to 12 million. The Fed hates that. Why does the Fed hate that? Because if people can quit their jobs and get higher paying jobs, that the Fed thinks is inflationary, so they attack the labor supply. But now, job openings look like where it should be. Baby boomers, nature wins. They age, they retire, they die. You need replacement workers, right? We have millennials. There's about 50 million millennials working. There's only 17 million baby boomers left. So job openings being this high looks pretty normal for a country of our size and our age. However, the Fed hated it at 12 million when the theme is the worst is over in housing. Now it's back to a level where they're more comfortable. Now it's a level where they could cut rates. Now if the labor market gets softer, they feel a little bit better being dovish. So we're getting closer to that level to get that next stage. We're not quite there yet. Now I know a lot of people over the last 2 years says, oh, well, the BLS data is numbers fake, right? And then I go, well, you see the green? Those are upward revisions. You see the red? Those are negative revisions. Happens all the time. Doesn't matter who's in the White House. Doesn't matter who's in Congress. There is no cabal out there. We had very high negative revisions in 2018 and 19. We've had very high negative revisions here. Because why? The BLS basically takes a survey. After the survey, 1 year later, they take the tax returns and see if the data was correct. That's why you get upward revisions and downward revisions. So the labor market hasn't broken yet. I know a lot of people thought that was the case last year. We had to keep people kind of in line that mortgage rates aren't really going to go below 6% because the labor market isn't breaking, but it's getting softer, right? And since the Federal Reserve raised their unemployment targets, for everyone in this room, the worst is over. We get a little bit lower rates, everyone does more business. Now this is the NAR's total active inventory, going back to 1982. I call this crayon economics. Does anybody here remember how much inventory was here in 2007? Anybody want to take a guess?
Close to 5 million.
We had 4 million active inventory in 2007. Now, you see all these YouTubers and they go, oh my God, inventory is surging. It's getting out of control. There's their surge. Too small. That is not going to get the job done. I'm sorry. That was a problem. This, no. 1.24 million. Using the NAR's data, which is a little bit different than ours, that's all the inventory that is. Considering it is going into the 4th year of the lowest home sales. So how do we explain this? In the past, we used to have rising inventory and rising sales. Well, in 2010, qualified mortgage came into place, which means everybody gets a 30-year fix mostly. And what does that mean? What home buyer doesn't give you a house? when they buy a house? Does anybody know? First-time home buyer. Okay? So 70 to 80% of home sellers are buyers. That leaves 20 to 30% of inventory left. What creature ended up being the biggest home buyer in the last 13 years? It wasn't BlackRock. It was the millennials. They bought all the homes, and they don't even give you one. So inventory slowly was moving lower and lower and lower and lower, and everybody was blaming Wall Street, but it was the millennials. Yes, they were the biggest housing demographic patch in the history of America, so they started buying really in 2013, so it's not a shock. They financed 90% of their purchases, so mortgage demand grew. Millennials became the highest buyer. Inventory got to a very bad level. Right? So if you want to understand why this looks so different than previous, qualified mortgage, and we have the biggest housing demographic patch ever, they were the one buying homes, and they don't give you one. Right? If a baby boomer sells their house, they give you one. If a Gen X sells a house, they give you one. But a millennial, elderly millennials, yes. But this is why we got to really, really bad levels. And this is all we got. So if you have an Uncle Dave, if you listen to those crazy YouTubers out there, you show them this chart and go, no. Back then, 4 million, 1.24. The average going back decades is 2 to 2.5 million. That would be normal. So we're not back to normal. We're not going to get normal this year either. Now, when I talk about trying to get everyone off of the Housing 2008 discussion, there is one period in time in history where this marketplace looks almost exactly the same. It's the early 1980s. Back then, guess who was playing the millennials role? Baby boomers. They were the ones buying all the homes. If I told you home prices rose faster from 1977 to 1979 than 2020 to 2022, even with higher rates back then, would you believe me? It happened. Housing typically moves with inflation. The hottest home price growth period post-World War II was 1943 to 1947. Some of those years were 20% plus. The late 70s, inflation took off, home prices took off. Pandemic, inflation took off, home prices took off. Housing bubble. Inflation really didn't take off. That was a credit boom and credit bust. But, just like in the late 70s, mortgage rates got up to 18% in the early 1980s. Baby boomers bought, rates went up, home sales crashed. If I told you that affordability was much worse in the early 1980s than now, would you believe me? It was. Back then, everybody's saying, it's a renter nation. Nobody's going to buy homes. Guess what happened? Recession happened, mortgage rates fell 2.5% lower. It actually went from eventually 18 to 13%. Vertical increase in home sales. More inventory, less workers, worse financial profiles, and even back in the worst affordability period post-World War II when rates fell. Why? You have a product that everyone needs. Every year, millions and millions of people buy homes. So here, very similar. I wouldn't say home sales boomed during COVID, but it definitely picked up a little bit, and then it crashed. And then we've been at record low levels. We're going into the fourth year. However, whenever mortgage rates get down to 6%, the demand picks up. When that occurs, then mortgage rates shoot right back up. We get sub 6% mortgage rates. We handle there. Everyone does more business. And now we're a little bit later in the economic cycle. So when I say the worst is over, inventory's up. Right? The Fed is cutting rates. The spreads are getting better. The worst is over for housing. But if you wanted to correlate this, don't use 2008. Use the early 1980s. And even back then, with worse affordability, home sales went vertical. Home sales started to grow. Inventory grew. Sales grew. That's what we want to see for the housing market going out in the future. By the way, how many people here were told BlackRock bought all the homes in America? Raise of hands. Okay. It's not BlackRock, it's Blackstone. And Blackstone owns 0.06% of all the homes in America. The Rock, the Stone, WWF Wrestling, yeah, you can get it mixed up. They don't own a lot of homes. I'm sorry to say. They have never owned a lot of homes. Just to give you an example, I've been dealing with this for more than 13 years. From 2011 to 2017, articles are written and said, oh my God, the Wall Street, the pension funds, they're buying all the homes. They bought 36 billion homes. So dollars worth of homes. Sounds like a lot of money, right? During that period of time, 36 million plus homes were bought. Guess how much $36 billion was worth? Roughly 200,000 homes. Very, very small. When we look at what happened COVID, Wall Street never even got to 3%. They get all the headlines, and the reason I fight this is that a lot of people say, well, Wall Street buys all the homes, and when things go bad for them, they're going to flood the market, sell all their homes at a discount. And who's crazy to buy homes then? Because BlackRock owns everything. I think the highest number I saw is they bought 44% of all the homes in 2023. The internet lies, right? It's your job to show this data to your clients so they don't get sucked in to the internet lying. This, not big enough. Millennials, right? Those pesky kids. They were the biggest home buyers for years and they don't even give you a house. So when we think of this, just remember, again, it's our job to give clients the best data possible so they feel a little bit more comfortable. Right? And until you show them the charts, they're going to listen to Uncle Dave, they're going to listen to people in YouTube or TikTok, but not this. So today, purchase application data came out. Again, positive 7% year over year, 1% week to week. Quietly, and still today, nobody talks about this. It's been a theme of ours for the last 2 months. For the first time in many years, purchase application data is positive year over year. Majority of the time. It has been so long for me to say the week-to-week data and the year-over-year data is positive year-to-date. Now, it's working from a very low level. So purchase application data is back to a level where Gangster's Paradise was the #1 song in America, right? No Doubt was the great band. New, fresh band, back in the 1990s. Fellow Gen Xer here, you know. We kind of love it that it's always a fight versus the baby boomers and millennials. But Gen X, I still have my AOL account. Nobody's hacking me, right? Let them fight it out. We don't care. Let them have that. So, purchase application up again, but we're doing this with elevated rates. We've always seen the data get better when mortgage rates go from 6.64% down to 6%. We get higher growth in the purchase apps. Here, it's not even the case. We're elevated rates. The data is getting better. Positive, why? Because the worst is done with housing. Every year, wages grow. Every year, household formation happens. We're not complicated people. In the last decade, when I used to speak, I said, we're very simple. We rent, we date, we mate, we get married 3.5 years after marriage, we have kids, we buy single-family homes. This is what we've been doing post-World War II. And even with elevated rates, even with elevated home prices, we still have near 5 million total home sales. So people go, how do people buy homes? It's so, well, if you take the NAR data nationally, you need about $103,000 to $110,000 to buy a house in America. Dual household incomes. One makes 90, the other makes 70. There you go. That's how you get 5 million near home sales. That's how you still have millennials, the biggest home buyers in America still. And even with elevated rates, this index has been positive. You won't hear it from anybody else because nobody as nerdy as I am. And again, the first time, probably like 4 years, that purchase application data is positive even with elevated rates. Just imagine everything I told you. If the economic data gets softer, labor market gets softer, guess what happens? Rates go lower. If this data line looks like this with elevated rates, everyone is doing more business, right? The spreads are getting better. That slow dance is more intimate. And we have more inventory, all positives for the housing market. Now, we have a weekly pending contract data that comes out. Our weekly pending contract data has improved recently as purchase application data has improved, as rates have come down. Housing market, last year when rates got towards 6%, it was actually beating 2023 and 2022 data, and then rates went up to 7.25. Now that they're coming back down a little bit, the data is picking up. We believe we can get 500,000 more home sales stick if mortgage rates just hit down to 6 million or 6% and just stay there. So again, The worst is over because it's the 4th calendar year of the lowest home sales ever, but we've seen just a little bit move lower in rates. The demand has picked up to the first time we're positive year to date. Now, our pending contracts on a weekly index, not the monthly, we're actually positive year over year. And I say this is with rates still in the high 6s. Imagine if going down to 6. If we get sub 6% mortgage rates, every single one of you are doing more business because we see it in the data. We saw it last year. We saw it at the end of 2022 going into 2023. We have purchase application data grow with duration. So this is a very encouraging, again, you will not hear this from anybody. Not a lot of people have this data. Housing Wire subscribers do. But you can show this to your clients. You've already seen the positive trends because guess what? The market doesn't care about what you think or your clients think. Millions of people are going to buy homes. It's very simple. Rates go lower, 10-year yield goes lower, more demand happens. Now, this is to me the best story for housing last year and this year. Inventory is growing. I'm going to ask a really crazy question. Does anybody know how low inventory got in March of 2022? We have a different data than the NAR. Our data is fresh weekly data. It's single-family homes that are not in contract, but that are available to sale. In March of 2022, inventory got to 240,000 homes across the country. You guys remember the game Hungry Hungry Hippos? Oh yeah! We had 500 hippos and one ball. That was what I called a savagely unhealthy housing market. If mortgage rates didn't go up in 2022, we would have had another year of 19 to 20% home price growth, coming off of a 10% 2020, coming off of 19% 2022 or 2021. That is not healthy for everyone. Home prices escalating out of control is not good for anyone here. So inventory has to grow. Now, we're not mortgage rate lockdown people. We believe higher rates, softness in mortgage demand. And how do we prove this? You guys all saw the model. If 70 to 80% of home sellers buy homes, and those millennials buy homes with mortgage, if mortgage demand is suppressed, you could have inventory growth. So 240,000. Oh, that was terrible. I remember seeing a house in Los Angeles. It wasn't a very good house. There was 247 people in line just to look at it. Okay? And it was like $680,000, and it was probably really worth $300,000. It's just nobody cared. There wasn't that much product. But now, inventory's up. So you don't fear supply, you love supply. Because what happens? Inventory goes up, more choices. Your sellers have more choices. They don't have to worry about, if I put my house on the market and there's 25 bids on one house, what if I don't get it? Now, picking up, positive. Price growth slowing down, positive. If I took 2007 and 11 out of the equation, post-World War II, do you know how many years home prices fell in America nationally? Does anybody want to guess? 1. 1 year. 1990. I was a sophomore in high school. 1%. That was it. That was mostly due to Southern California's economy, too. If Southern California was taken out of the data, the home prices would have about 2% nationally. It's very rare in America for home prices to fall. Why? I always say there's one group of people we never listen to in America. Middle-aged men podcast stock traders. They are the worst. For 14 years, they keep on telling me, oh my God, everyone's going to rush to sell their house. They have all this equity. I go, and where are they going? Where are they going? Have you told your wife where you're taking her after you sell your house? Have you told your kids what school they're going? They go, what? Yeah. If you sell your house and you have nowhere to live, guess what? Your kids are eating from the streets. The police are going to come take you away because you're a terrible father, terrible husband. So I want you stock traders to go all to your wives and tell them, guys, come on, we're moving. We're going to sleeping on the couch, having kids throw their toys at you. Not going to happen, right? So now we see this. Right? Like, this is why it's really rare for home prices to fall. 2007, 11, what happened? Major distress sellers, you'll see those charts later. But here, inventory has grown a lot. No price crash happened. But this is a positive because price growth is cooling down. Now, when we look at the Utah data, you guys see that slope almost vertical in 2022. 2022 to me was the craziest housing year ever. I mean, ever. Crazier than 2008, crazier than COVID. We went from a marketplace where I think 84.7% of the homes in America in 2022 had multiple bids. We're not talking 3, 4, or 5. We're talking 15, 20, 30, 40, some houses at 50. Not a good housing market. Prices were going to be up to 18 to 19% a year. Then mortgage rates had the fastest increase in the history. 3 to 7% in 1 year. Okay? We had the fastest crash in home sales. Inventory vertically grew, and then it kind of stopped. Right? The second half of 2022, nationally, home prices were authentically falling, except they were authentically falling from a 19% start of the year, which means we ended up the year only up 6%. But now the inventory data here in Utah looks normal like it does across the country. Growing. We're almost back up to pre-COVID levels. And by the way, 2019 inventory levels was the 5-decade low before COVID hit us. We actually broke the all-time lows before COVID hit us out there. So what we're doing is going back to a normal housing market where people have choices. Now, our data lines are very unique in their nature. We have something called the new listings. The new listings data line is homes that come onto the market that don't have a contract. Mike Simonson, my colleague who owns Altos Research, in 2007, he went to Wall Street, saw Lehman Brothers, says, Lehman Brothers, we have a way of tracking housing that's different. Lehman Brothers looked at him and said, well, what are you trying to tell us? The housing market's breaking. We have 85 analysts. We know what we're doing. Okay. Mike Simonson walks 15 feet. Sees Goldman Sachs. Goldman Sachs says, hey, what's up? Mike says, check our data out. Goldman Sachs goes back to their office and goes, hey, the housing market looks like it's breaking. What are we going to do? We're going to short the housing market and make $10 billion. Lehman Brothers, on the other hand, went out of business. We believe we are the most prolific housing data trackers on planet Earth. We are not shy about it. We challenge everyone to live debates to show them. And this data line is our golden egg that a lot of other companies started to copy our models. When we see stress in the national market, we'll see new listings data take off. Now, we're just trying to get back to normal. Pre-COVID, 2013 to 2019, new listings data is very seasonal, like all housing data is very seasonal. 80,000 to 110,000 new listings in the seasonal peak months. The last 2 years, anybody remember the Airbnb crash that everyone was talking about? There was like 7 million Airbnbs that are going to hit the market. The last 2 years, when every podcast stock trader said millions of people are going to sell, it was the 2 lowest new listings data in the history of the United States. We are just desperately trying to get back to 80,000, which would be very normal. And remember, most sellers are home buyers, positive this year, right? I'm just looking just to get back to minimum 80K. I'll be completely happy. It looks like we'll get there. But do you know what this data line was doing from 2008 to 2012? 250 to 400,000 per week for years, per week. That means the highest new listings data the last 5 years, which the last 5 years have been the lowest in history, 91,000. I could double that and we wouldn't even get to the bottom level of the 2008 to 2012 crisis. So if people are telling you it's 2008, you go, no, homie, because this thing was exploding higher. They don't have the data. They're not actually serious people either. But your job is to convince and tell people what's going on. So you're going to have all these charts. And I speak at state association realtors all across the country. I'm even going to Alaska. All right? And every time people get all the data lines, they feel more confident, but their clients go, wow, I didn't know that. New listings data in Utah looks pretty normal. There's no acceleration out here because most of your sellers, not all, but most of your sellers are going to be home buyers. So why is this very stable data line? Well, if you think about it, no matter where prices and mortgage rates are, if most of your sellers are home buyers, then they feel comfortable. That means whoever else is in the market kind of feels somewhat comfortable. But we don't see the stress in the data lines for Utah, just like we don't see There is two states in the country. 40% of the inventory growth in America were Texas and Florida last year. 40. Now, they're outsized population states, but those are two states that have different problems. Do you know what they're doing in Florida now, what they're talking about? Trying to get rid of property taxes. Insurance, hurricanes. I've been to Boise twice already. I've already been to Utah once. If I were you guys, I'd be marketing to Texas and Florida and tell them, come on over. It might get cold sometimes. We have great weather. You can ski. You don't have to worry about fires, right? You don't have to worry about hurricanes. Get some of those buyers. I know Boise's doing it. I just got back from Boise. They're marketing like crazy out there. You guys have this advantage here. Texas and Florida, they don't. So if you hear Florida get rid of property taxes, it's because they don't have a solution for the insurance yet. So they need to get the cost of housing down. How many people here knew 1/3 of all homes have price cuts year-round? Brittany, cheater. Okay. Yes. But is that surprising to you? How many people are surprised that 1/3 of all homes have price cuts? Good. Because other states, they get surprised. They go, with your home sellers who think their 1976 house is worth so much? A lot of times, you get an overpriced house initially. They lower the price down to meet the marketplace. This looks very normal. God, it was terrible in March of 2022. Price cut percentage was so low, right? That's not a healthy market. So the price cut percentage is increasing versus the previous 2 years looks perfectly healthy to me. We need price growth to cool down, to let wages and household formation grow. So when rates go lower, nothing but all the way up for home sales. Price cut percentages in Utah, nothing special, nothing abnormal. A little bit lower than what we saw last year, or in 2023. So I don't see Utah's data anything different than nationally. Where I see it's two states, Florida and Texas, who have trouble selling some of the houses, especially the condo market in Florida is a disaster. But in Utah, nothing abnormal. If we see abnormal, inventory skyrockets, new listings data skyrockets, price cut percentage skyrockets, we're just getting back to a normal market. It's been so long since we've had a normal market, we don't know what it looks like. And if you ever have people go, well, the housing market was booming and sales and home prices have to crash, the housing market was never booming. This is the Mortgage Banking Association's Credit Availability Index. As you can see, that is one hell of a water slide. That data line was exploding, sales were exploding, and nothing has been going on for 14 years. Right? Credit cannot crash anymore because credit has gone nowhere. Very, very boring vanilla housing market, very stable. We had very high volumes of purchases and refinances during COVID, even with this index near record lows. So the housing market, the credit boom and credit bust of that period is over. You show everybody the waterfall chart, they'll have a better understanding. Now this chart is one of my favorite charts. When I die, they're going to put this on my tombstone. Because I've been fighting Uncle Dave for 14 years. I've cataloged this every single year since 2013, all the housing price crash people. I've actually documented their forecasts and calls. They are like horrifically untalented people. But they always keep on saying housing 2008 for some reason. Like men would rather spend the next 4 decades talking about housing 2008 than get therapy. Okay? But here, I go, okay. Crayon economics. We draw those black lines to make it simple. I go, homie, credit was breaking in 2005, 6, 7, and then 2008. Then the job loss recession happened. There's your 2008. Again, too small. Cannot get the job done. Back then, years of credit stress. For those of you that haven't listened to our podcast today, the podcast is about the FHA delinquency loans, and that's the big thing. There's 51 million loans in America. The FHA delinquency is not even 0.4% of the loans that are in stress compared to all the loans out there. Mortgage forbearance, any of you guys remember mortgage forbearance? Oh yeah, those guys were great. in the summer of 2020. I coined them the forbearance crash bros. A bunch of males on YouTube who have never studied economics in their life are going to tell you forbearance basically ended in October of 2020, right? Because pretty much everyone who made over 60,000 got their jobs back. Forbearance, instead of being 15 million loans delinquents, it's down to 0.38% of all the loans are in forbearance today. Credit market was breaking for years. Now, not so much. So I encourage everyone, listen to the podcast, Housing Wire Daily. We go over the FHA. There's some things you can need to think about for the FHA delinquencies, and there's some things you don't. Housing 2008 is a myth. It's a propaganda. I understand why the Chinese, Russians, and Iranians do it, disinformation, but this is homegrown. There's a lot of YouTubers out there who keep on doing this, and we've documented it for 13 years, and trust me, I've challenged them to live debates. And the crazy ones that do accept it did not end well for any of them. Now, this is my favorite chart. This is the FICO score of American households post-COVID 2010, post-qualified mortgage 2010. You can see the whole credit landscape change. Why? Because everybody gets 30-year fixed mortgages. There's no more option arm loans. There's no more stated incomes, 80-20. Everyone's verified. So naturally, the FICO score is going to look great. A lot of people think this is FICO score inflation. No. We just originated a lot of loans, purchases, and refinances. Household balance sheets have never looked better. Does anybody know the total equity value of homes in America? 52 trillion. Bigger than the whole GDP of China. Do you know how much of that is nested equity? $38 trillion. Maybe Cleopatra, in her prime, adjusting to inflation, had more wealth than America. But these homeowners on paper have never looked better. Fixed debt cost, rising wages. What's the best hedge against inflation? It's a 30-year fixed mortgage in America. I get counterparts across the world hate us. They hate me. I brag about the 30-year fixed. Do you know what they're doing in Canada today? 90-year loan modifications. Your mortgage will outlive your grandkids. Short-term rates. Oh, they used to brag about, all these countries used to brag. We're tied to short-term rates. Rates are never going to rise again. Guess what? We're borrowing lower than you. I said, homie, one day you're going to pay the piper. Don't come crying to me. Oh, they're all crying. Oh, my God, you guys have the 30-year fix. Yes. So this is why this chart looks so good. Fixed debt costs, rising wages. The whole system is rigged for homeowners, right? The reason they do this, the 30-year fix, so as your wages rise, you have more disposable income. This is why homeowners in America have never looked better, really. Once you got qualified mortgage in, it's good. Right? So the majority of the housing stock, by the way, does anybody know the percentage of homes that don't even have a mortgage? 40% of homes don't even have a mortgage. Oh, foreclosure crisis with that number. Oh, yeah. Cute. Okay. So again, show this chart to your clients. Homeowners on paper have looked better. This explains what happened the last 4 years. This chart is so beautiful that sometimes late at night, around 8 o'clock, I bring my cognac out, I put on some jazz music, and I sit and just look at her. This is just art, economic art, and the world hates us for this. Now, again, it's Housing 2008. I don't even have to draw black lines for this. Gee, we had near 15 million loans that were in some stage of delinquency back then. Now, historically, 1 to 4% of all loans have some form of distress. That's very normal, right? 1.5 to 2 million people lose their jobs each month. Jobless claims don't go to zero. Some people have bad spending habits. You guys see those reality shows? Some people have bad spending habits. But this doesn't mean the majority of stock are going to be delinquent and going into foreclosure. So, as you guys saw the earlier chart, my tombstone chart, we had credit breaking for years. Then the job loss recession happened and everything escalated out of control. Now, we're just trying to get back to normal. Normal delinquencies, right? Credit cards up, auto loan delinquencies up. Majority of that, renter households. Single renter households, young renter households. That's where the majority of the stress is. Homeowners on paper, even with the FHA delinquencies back to normal, 15%, looks very healthy and good. Now, what's the percentage of homes that have 6% or lower mortgage rates? 82%. 82% of homes in America have 6%. But every single week, every single month since 2022, there are people that sell their 3, 4, 5% mortgage rates to buy homes. What's wrong with them? Life happens. Total payment cost for people that are buying homes, it's not as unaffordable to them as it is to other people. So a lot of times people use this median income to median price, all that stuff. If you're trying to qualify renter financial profiles to homeowners, it doesn't make sense. 1/3 of the society is going to be lifelong renters. Service sector does not have the incomes unless you're part of a dual household income. People sell their mortgages and buy other ones with higher rates because they can afford the total payment. So even with affordability terrible the last 2 years, we still had near 5 million total home sales. If I just get 1 million more mortgage buyers, we're back to the peak total home sales of the last decade. So they're there. But now you get to see why just mortgage rates go lower, the worst is over, everyone here does more business. Now, does anybody want to guess what the percentage of underwater homes were in 2010? In 2010, we had over 23% of homes underwater. Today, it's less than 2%. The all-time low is 1.7. How do you get LTVs at 125? Well, if you get an FHA loan, you put a solar panel loan on it or a 203 rehab loan, you can get an LTV here. So this means majority, really, of all homeowners have selling equity. None are underwater. The foreclosure crisis they tell you about, wait till you see the next chart. The homes that do have, so remember, 40% of homes don't have a mortgage, but the people that do have mortgages, the loan to value is 46.6. Oh, did we get better pricing on a refi on that? Yes. Back in 2008, around that period, it was 85%. So we had a quarter of the homes underwater. The LTV data was very elevated. We had forced credit sellers, new listings data, forced foreclosures, bankruptcies, everything. Now, this is another chart. This? Too small. Can't get the job done. 85% LTVs, 23% homes underwater. Problem if you are forced to sell your house. Now, not the case. So now you have a series of data lines, series of charts to show to your clients. And home sales have bottomed. Just get mortgage rates a little bit lower. Wages grow, household formation grows, dual household incomes. You can get sales to grow very similar to the early 1980s. Now here is home prices going back to 1942. As you can see, the housing bubble crash years, an abnormal period of time. Now you know why. We have so many foreclosures and bankruptcies and underwater homes. Here, the rest, pretty normal, pretty green. Forced credit sellers, and then home prices move with inflation. So if you need to show this chart to your clients or this data line, you actually have the background of what it takes to have a national home price crash. It's historically very rare. And if you want to understand why, how many people here are surprised home prices kept rising after 2022? A raise of hands on the national side. Okay. Well, you guys see the data. Inventory is low. Credit is good. Nobody's forced to sell. Thankfully, a lot of homeowners aren't middle-aged men podcast stock traders. Guess what happens? The data looks pretty normal considering all the variables here. But again, 2007 to 11 was the abnormal period. You take that data line, you have all the charts now to explain that period and why it isn't today. Now, the unfortunate side of having active inventory too low and really good homeowners, prices escalated out of control. Right? If you saw that chart, you go, oh my God, we got to revert to a mean. That's another thing podcast stock traders do. Reversion to the mean. It happened, yeah, it happened then. You have to have the same variables. So what happened? Everyone was shocked. Prices kept rising. Supply and demand economics. Inventory is low. Homeowners are in good spot. Home prices kept on rising. Rent inflation took off as well. Right? This gap is not going to catch itself like back then. You need the same kind of variables. 4 million active inventories, 50 million loans and delinquencies, LTVs near 90%. None of those things are here. But now all of you have the data. And now you could have all my charts sliding into your DMs. This presentation has been very popular nationally because, as you can see, you're all housing experts now. You're better than those YouTube people. You're better than TikTok is so terrible, by the way. You're better than those TikTokers. You're better than those stock traders because you have the data. The greatest antidote to fear is data. But you have to present it in a way for your clients to understand. And this presentation is just to basically give you a history, but also tell you where we are in the economic cycle. What we've seen, even with elevated rates, demand's picking up a little bit. Just imagine if mortgage rates go a little bit lower, even sub 6%, everyone here does more business. The worst in housing is over. Thank you very much. Well, history, I could give a whole dissertation on spreads, but everyone would be boring out. If you go back to every economic cycle post the 1970s, the spreads only get better when the Fed starts cutting rates and volatility compresses. So the spreads are halfway back to normal. So what you need is more rate cuts and less volatility. The spreads will slowly move lower down toward 2%. That has worked in every cycle in the past. That would historically work now. That's why the spreads have gotten better in the last 2 years. We're not back to normal, but we're halfway there. So more rate cuts, less volatility. I don't know if you guys have noticed, on days where the 10-year yield goes up, pricing isn't as bad anymore, right? Because the spreads have gotten better when yields rises. That is a history of economic cycles and mortgage spreads. Slow dance coming together. So more rate cuts, less volatility, spreads can compress a little bit more. Also, the government can take away the extra GSE fees, and that can allow a little bit more margins, a little bit better spreads. That would be a positive for the housing market on that. But we're still quite not in a full rate cut cycle. If that happens, the spreads can compress.
Why does the Fed want the labor market to soften?
Because the Fed believes their dual mandate is stable prices and peak unemployment. Because inflation took off so much on their watch, they're a little bit shy and timid about cutting rates too low. This is why I call about the spiking of the Fed's eggnog. They had a policy where they said, we would like basically the Fed funds rate to match inflation. Well, if that's the case, the Fed funds rate is 3%. Mortgage rates are 4 to 5% right now today. But they didn't. They changed it, and they believe that when the unemployment rate picks up, they will have more cover. I know this because the Fed staffers in 2 of the cities follow me, and I bash them on this all the time because there's many statements over the last 3 years that they basically say this. We want the labor market to get softer, the unemployment rate rises, still the economy's in expansion mode. If that happens, they feel more, oh wait, they did that last year. There was no rate cuts until the revisions of the jobs data. It's not as good. Okay, emergency 50 basis points rate cuts. When labor data gets softer, they will fold because they are folders. But until then, they're going to take it a little bit slower until the labor market gets softer.
So that's the wrong way to kind of view it, right?
That's not how I would do it, but I'm not the Fed. I'm just a Fed basher.
You have charts to show these same types of data points with population growth in conjunction with the house.
So population growth and migration are key. This is a good question because why is Texas and Florida more softer than other states? Migration has slowed down in Texas and Florida. Right? Economics is demographics and productivity, population growth, household formation. Those are the things that drive housing markets. And Texas and Florida have lived off of big migration data, but now their migration has slowed down, and they have to rely on their local wages. Not us California people who could go anywhere and buy homes anywhere, but without less migration, demand actually does soften up. You're relied on your household formation. Every state, Utah, very young state compared to other countries, other states, especially versus the East Coast, right? Younger populations that have migration is where the data is, but also affordability, right? This is why we say the Midwest could be the new South, because it's more affordable there, less weather drama. But you guys have something, you don't have hurricanes, and you don't have earthquakes, and you don't have fires. Push that, because you can get more migration going there. About what? Okay, so stagflation is something that happened in the late 70s. Late 70s, you had booming housing market, booming inflation. You had an oil shortage. Oil has to get to $450 to match the adjusted to inflation price of oil. Stagflation in that is probably unlikely because the unemployment rate has to go up to 10 to 11%. If the unemployment rate goes up to 10 to 11%, inflation won't be able to hold itself unless you have a supply shock. So you could have maybe a small case of stagflation where inflation is a little bit more elevated, the unemployment rate gets a little bit elevated, and growth slows down. But to have the 1970s stagflation, you need the housing market booming. Wages grow, inflation grows, economic growth, oil shortage. Those things can push inflation higher than normal. So that kind of stagflation, no. A lot of people talk about it. I still don't think people know what stagflation was back then. High unemployment rates, high inflation, lower growth, double-dip recession we had back then, and then it came back down. Our economy can't really handle an unemployment rate elevated because consumption will slow down. Back in the 70s, housing was booming. Rent inflation was booming back then. It's very hard to replicate that kind of labor force now back then. Back then, we had a shortage of homes. We had an oil shortage. It's really difficult to get that kind of stagflation unless we have another kind of COVID incident. And we all saw COVID was a brief, major spike in inflation all around the world, and then the disinflation happened. So I'm not worried about the 70s stagflation. Maybe something in a smaller duration for a very short period of time. But again, you're going to need some kind of supply issue or something that happens that changes the entire landscape of the world economics that we've seen in the last 30 or 40 years. That was not the case in the late 70s. Anybody with more questions? I love questions.
What are we preparing for next week?
Well, next week is, football, they have Hell Week. We have Hell Economic Week next week. We have Liberation Day, which tariffs. Now, a lot of people talk to me about tariffs. I always encourage everyone. On November 7th, we did a podcast about Trump and tariffs and everything, and we kind of said, I have this meme. How many of you remember Karate Kid? Okay. Wax on, wax off, tariffs on, tariffs off. Okay. Wayne's World. Game on, game off. Okay, so that's kind of been my theme. Trying to get everyone ready. This is just how he operates. It's really difficult for a country like for us to have tariffs, and I could prove this to you. If you really believed in tariffs, you would literally put it day one, because it takes 15 to 20 years for that to work. You're going to change the entire U.S. economic system to get everyone to produce here, and you're going to get retaliatory tariffs. If you really believed in tariffs, and I did this in 2016 when Trump won too, said, back then he waited 2 years. Didn't do the trade war tap dance. Waited till he got the corporate tax, then went after China back and forth. Tariffs on, tariffs off. Stocks didn't like it. Here, same thing. He went early. So we'll see what happens next week. It's Liberation Day. We'll see how much reciprocal tariffs. I don't believe, until I actually see somebody says, we're going to have the tariffs on, that's it. No negotiation. Right? And partly the problem is that our economy is so much stronger than everyone else's. Our currency needs to come lower for us to export a lot of stuff. We just can't get the dollar that lower. This is why I'm not a tariff person. I really believe in that. Because if he was, you would have had it on day one, because it's going to take probably 15 to 20 years to change the entire dynamics of the U.S. So a lot of confusion could happen next week, and it's jobs week. And now you know, labor over inflation, right? So the jobs data is key, and the Fed has already raised its unemployment rate target, which means they're a little bit more concerned, which is why the 10-year yield is lower, right? Last year, everybody told me, oh my God, we're going to have tariffs, 8% mortgage rates, the 10-year yield is going to go 6%, inflation is going to... I've done this dance before. So next week there could be a lot of volatility. So good luck on pricing on those days. By the way, as you can see, I don't have much of a life. If any of you have Instagram, I literally have 500,000 people go there every month. And we do this every day with Instagram videos and stories. We try to talk about everything. My job is really economic cycles first, housing second. So we try to explain, and it's so crazy. I mean, even my smart Harvard, MIT guys are, what's going on? I said, you got to follow the 10 wheel. It's a slow dance. I'm like, what does that mean? You're a millennial. You don't know. So we try to make sense of it all, because if it's crazy for my smart, nerdy economic friends, then I know everyone else is confused as everyone. And this is a very, very confusing time. But just always remember, labor over inflation. That's what the Fed is targeting. Any other questions?
Lock or don't lock?
By the way, if anybody asks me on lock or don't lock, I was an LO for 17 years. I never floated. Me, with all the charts and everything, I said, you shouldn't float. And people go, okay. So I never wanted to deal with that stress. I never wanted the clients to deal with that stress, because guess what? I understand the competition, and now it's so different. We were joking. Does anybody remember a Transbox? Remember? There was something called a fax machine, and you used to get your rate sheets through fax machine, and if you didn't have the paper there, you wouldn't get your rate sheets. And I used to do something where we poke holes into a folder, and then we put all the paper in there, and we have to get it to a Things are so fast and productive. I realize why some people have to float, because the client is out there, checking rates with everyone somewhere else. I never floated. And then people ask me, should I buy a house? This is my honest to God answer I've given on TV and every single day. If you are asking me if you should buy a house, hell no. You're a grown-ass man. I don't even know your name, and you're asking a stranger if you should buy a house. No. You sound like someone that needs a landlord, that if you need to plunge your toilet, your landlord could come do it. Grow up. You're not a kid anymore. Right? If you don't know, like I always say, housing is the cost of shelter, it's your own capacity to own the debt, your total payment, you sleep with that payment at night, you wake up with it in the morning, and if that is good for you, oh my God, you're like everyone else. Because millions and millions of people buy homes every single year. If you're not ready, you're not ready. But that 28-year-old, by the way, single women have outdone single men for like 4 decades. Not a lot of people know this, because women have their stuff together. Men! It's always men. God, they don't have their stuff together. So, it's the cost of shelter. Don't think of it as investment, the cost of shelter. And now you see why. The whole system is rigged. Fixed debt costs, rising wages. This is what's happened post-World War II. So don't ask me to lock or float. Don't ask me to buy a home. I will be brutal out there, as I have with many people who get embarrassed when I do this at conferences too. Any other questions? Going once, going twice. Thank you so much.